we saw a cut, 0.25% to 0.75%. The central bank's decision, widely expected. It seeks to shield Australia's economy from rising global risks. The Reserve Bank head, Philip Lowe, said he's prepared to ease monetary policy further if needed to support growth. Raffaele Bertoni is the Gulf Investment Corporation head of debt capital markets and portfolio manager. So, a very clear message from the RBA. Quite surprising for the market. We were expecting a hawkish cut. It's far from that. It's far from a hawkish cut. What does it do to your thinking about global rates?
This is a trend that we are experiencing all around the world. The Australian economic data have been weaker recently, especially the labor data, which are very sensitive for any government. And I'm not surprised that the central bank decided to cut and also to remain dovish, which is a strong message for the market and the currency.
Okay, so translate that back to rates. By the way, for our viewers out there, there is a T-Live on your Bloomberg terminal. It's got all the top points. We're at a gentle turning point. That's one of the lines coming from Mr. Lowe. The risks of the global economy have tilted to the downside. I want to translate this into the rates discursive, because Stephen Major's point when he was with Nara and myself was that Aussie and Kiwi are at the front. They're leading at the front in terms of the rate cut momentum. Draw that differential to treasuries for me. If I've got Aussie and Kiwi at the front and I've got the Fed not doing as much as you said, what happens to the spreads?
The spread should widen, and this reflects the different nature of the two economies. New Zealand and Australia are very much depending on the global trade. They are countries very export-oriented, with a strong GDP percentage of export of oil and other resources. The difference is going to be more on the spread between the two economies, but we need to bear in mind that the room of maneuver, especially for RBA, is very limited at the moment. After this cut, they don't have much ammunition left, which is the main difference with the Fed, which is still
they still got a full tank. They still got a reasonably full tank to.
Also because they readjusted the rates last year, so that's the advantage, the difference with the rest of the world.
Can I circle back to what we just saw there now from Juliet, which is the deflation story from Korea? Let's just have a look at this in the GTV library very quickly. 2810 is the GTV if you need it. Prices falling by 0.4%. Exports down for 12 months in a row. The Bank of Korea warned against being excessive deflation risk, but this has a global potential ramification for us.
No, not necessarily.
Okay.
The South Korea economy is a very export-oriented economy, and therefore are more sensitive to the global economic environment. Other countries, for example, UK, are quite different. All the countries with a deficit in the payment in the balance of payment, they generate general inflation. South Korea is the opposite case.